Hello everyone and welcome back to the channel. I'm Ivo, Depth Stocks Chief Market Analyst, and today we are diving deep into this ongoing market rally, and what we'll do is unpack what the checkpoints for this rally are, why the 5700 mark is such a battleground for the S&P 500, and look closely at the underlying health or lack thereof of this move. We'll also shift gears and look at the crypto space, specifically some bullish signals emerging around Bitcoin ETFs like IBIT, institutional adoption news, and where Bitcoin itself might be technically heading, so stick around to find out. First up, let's talk about the idea of checkpoints. Think of this rally like climbing a mountain. You reach a certain price level or checkpoint along the way. Yesterday, we cleared the 5600 mark, and at least for the time being. At each checkpoint, traders often do two things. One, they might trim some of their winning positions and take a bit of profit off the table. And two, they might let the rest of their position run, but tighten the stop loss just in case the market reverses. And if we break decisively through a checkpoint, the next target comes into view. For me, after the 5700, the next zone looks like 5750 and 5800 after that. But, and this is a big but, we need to convincingly conquer the 5700 first. So why 5700? And why is it such a tough nut to crack? It's not just a random number. Two significant technical levels are sitting right there. First, the 200-day exponential moving average, or EMA, is right around 5690, and we actually haven't closed above this key long-term average since way back in March, with the S&P 500 already up a hefty 70% from its April lows. Many traders see this level as a natural place to sell or take profit. The second thing is, slightly above it, around the 5990 mark, is the 21-week EMA. This is a massive momentum gauge. Closing above it suggests positive momentum, and below signals negative momentum. And again, the last time we closed above this was in early March. So the price poked its head above the 5690 level during Friday's session, but could not hold on to this close. It got pushed back down partly due to some disappointing earning rejections from Apple and Amazon, and maybe some jitters around the US and Iran tensions, and even somewhat positive headlines about the potential US-China trade talks in after hours could not keep the price firmly above that level initially. The NFPs, however, did say today, and as the reading was an absolute best case for the market, strong enough to fend off a recession fear, but not strong enough to remove rate cuts from the table. And now, for a breakout above such an important resistance to be sustainable, you need some broad participation. You need lots of stocks moving higher together. The good thing is that we are now seeing something like this. The tech sector, the Nasdaq 100 ETF, for example, or the QQQ, rallied almost 2% at one point on Friday, and the QQQE, which is the equal weight version of the Nasdaq, is about 2% higher. And that tells you we are seeing a bit more broad-based rally. Similarly, the S&P 500 jumped 1.5% late in the day, and the RSP, which is again the equal weight S&P 500 ETF, closed 1.5% higher. This means that in addition to the heavy lifting tech stocks have been doing, the broader market is also rallying. And of course, okay, credit where it's due. We did open and close above the 50-day moving average, the 50-day exponential moving average, sorry. And this is definitely a positive shift in character for the market. But despite that, this rally feels primarily mechanical, driven by positioning, algorithms, and maybe some fear of missing out, or the so-called FOMO, rather than being backed by strong fundamental improvements. And thing is that rallies like this can eventually reverse, and sometimes quite sharply, and nobody knows exactly when that will happen. So the takeaway for now is don't fight the trend, but proceed with caution. Ride the wave, but manage your risk carefully. And beyond the good jobs report we got on Friday, other factors are swirling around. As mentioned, Apple and Amazon earnings were not stellar, with warnings about the impact of China tariffs and the ongoing supply chain issues. We also heard hints from Japan's finance minister about potentially using the US treasuries as a card in trade talks, and this is mostly seen as a negotiating tactic, but enough to cause some market jitters. And there is also some comments from the US Vice President suggesting the war in Ukraine could continue for months, and this dampened the hopes for a near-term peace deal, which is something institutional investors are watching out for. And what we're watching out for is the performance of Rhine Metal stock. But anyway, yet, despite all of these potential negatives, the market did not break down below the key support levels. And when that headline about China, the headline about China evaluating potential US trade talks hit the market, the negative momentum on Thursday, I think, just evaporated. We rallied 1.4%, right back towards the 56.50 mark. And the thing is that this really highlights both the resilience of this mechanical rally and its underlying lack of strong fundamental conviction. This resilience is partly fueled by FOMO, and which is the fear of missing out. Many traders who missed the initial move are now jumping in on any small dip, and this creates a temporary, almost artificial support that might not hold up under genuine selling pressure. And we have plenty of negative catalysts lurking, yet the price keeps grinding higher. And this is a testament to that mechanical buying pressure overriding the fundamental concerns for now. So, to put it all together, what's a sensible plan? So, first, watch that 5800 level like a hawk until we see a decisive close above it, accompanied by broad market participation, which is better breath, and don't fully trust any breakout. If we do clear some of these levels convincingly with good volume, the next checkpoint zone is 57.20 and 57.35. From a risk management perspective, consider trimming exposure slightly at these checkpoints to lock in gains and keep tighter stop losses on the remaining positions. And maybe consider sizing any new long positions a bit smaller as the rally extends further without clear fundamental improvement. And okay, let's shift gears from the broader stock market to the crypto space, where we're seeing some interesting dynamics, particularly around the Bitcoin and the related ETFs. One interesting divergence, which I'm seeing, is that while skew in the S&P 500, which is measured by SPY options, has actually pulled back a bit, skew in Bitcoin ETFs, specifically in IBIT, has ticked noticeably higher. And just a quick refresher, skew looks at the implied volatility of call options versus put options. When skew rises, it means traders are paying relatively more for calls, which means they are betting on the price going up, compared to puts, which bets on the price going down. And it's often seen as a sign of growing bullish momentum or demand for the upside. So a rising IBISQ suggests options traders are increasingly positioning or hedging against a move higher in Bitcoin. And the takeaway here is that it appears institutions and larger traders are using dips as opportunities to accumulate positions in Bitcoin ETFs like, for example, IBIT. Adding another layer to this is the ongoing institutional adoption. Big news this week, which hit this week, is that Morgan Stanley announced it's opening up a new crypto offering for its wealth management clients. This is definitely another major traditional finance player getting more comfortable with digital assets. As more of these legacy institutions create pathways for clients to invest in Bitcoin and Ether, it potentially increases the flow of capital into the crypto space over time. Now let's look at the Bitcoin chart itself. We've seen a very strong rebound recently, and the Bitcoin is up about 18% since Liberation Day. And assuming this is a non-reference point for you, and it's a significant recovery. However, price is currently bumping up against resistance, specifically the zone around the recent swing high. And to break through this level and break through decisively, Bitcoin likely needs a fresh wave of buying volume and a catalyst. So keep a close eye on the volume bars on the chart. If we see volume surge as price challenges that resistance, it's a good sign. It could break through and potentially turn that resistance into a new support. And if volume fades as it approaches the resistance, it increases the chance of a pullback. All right, let's wrap it up here. Key things to watch, that critical 5680 level in the S&P 500. Does the market find broad support to break through, especially after the jobs report or this mechanical rally finally hits a wall in crypto? Keep an eye on those bullish sentiment signals and the impact of growing institutional access to whether Bitcoin can find the volume needed to overcome the current technical resistance. The earnings reports I'll be watching this week are Palantir, and for Monday, AMD, Supermicro and Arista for Tuesday, Uber on Wednesday, Shopify on Thursday, and also Coinbase the same day. In terms of macro events coming up next week, the focus will definitely be on the Fed, with markets pricing a rate cut in June. We are unlikely to get any surprises, especially given the latest jobs report and PCE data, and the Fed does not tend to surprise markets when they are pricing a rate cut of over 60% with over 60% probability. But be ready for some volatility, as we will be looking for any further signals on the amount of rate cuts the Fed will be doing. And basically, that's all for today's update. If you found this breakdown helpful, please hit that like button and consider subscribing if you have not done that already, of course. Let me know your thoughts on the market and crypto down in the comments. And thank you for watching, and I'll see you next week.